We will discuss crypto's great reset, how investors in digital assets will recover from the market's $1 trillion meltdown in this video. Before you watch this video, be sure to like it and follow our channel for future updates. 5 resets have shaped the history of the cryptocurrency. The first occurred in 2014, when Mt. Gox, which was essentially the only Bitcoin exchange in the world at the time, collapsed as a result of a hack that cost close to $500 million. The DAO breach, which occurred in 2016, was the second. In this incident, an attacker deceived a smart contract into giving up $60 million in Ethereum, which is now worth $8 billion. The third, which happened in January 2018, started a year-long collapse that destroyed 60% of the cryptocurrency market, or more than $700 million, largely in the form of worthless trash tokens. The fourth occurred in March 2020, when most international financial markets experienced a 40% decline in value, including cryptocurrency. Each reset not only resulted in rises in the price market capitalization, but also paved the door for quick innovation. Out of the ruins of Mt. Gox's collapse, the 2 largest exchanges in the United States, Coinbase and Kraken, were born because its CEO realized that people needed reliable venues to purchase Bitcoins. It's difficult to see businesses like Tesla purchasing Bitcoin prior to the COVID, given how the DAO's implosion and the ICO crash laid the foundation for the DeFi's expansion and the current popularity of the DAOs. It began last week with 5th reset. It might end up being the most significant one yet. This time, a sharp sell-off in the hazardous assets and abrupt disappearance of the $40 billion digital token, named Luna, that supported the $16 billion stablecoin, Terra USD, were to blame for the $1 trillion market collapse USD. Each USD was intended to be worth $1, as opposed to the freely floating Luna tokens. Between May 7 and May 12, about $56 billion fell out of circulation due to a perfect storm of greed and inadequate technology that caused the stablecoin to lose its peg. The most recent crypto meltdown serves as a further reminder of how get-rich-quick schemes can trump common sense at a fundamental level. The industry is being forced by the massive capital loss to confront the idea of leverage in the cryptocurrency markets, to ask whether innovation is only disguised leverage, and to consider whether algorithmic stablecoins as a whole may be doomed. The Terra Foundation, based in South Korea, attempted to address this issue by replacing many of the mechanisms that support the stability of the US dollar with an algorithm. When the price declines, a chance for arbitrage exists to exchange USD tokens worth less than $1 for Luna tokens for $1. Theoretically, the Anchor DeFi lending technology, which ran on the Luna blockchain, gave depositors 20% returns. A housing bubble in which subprime loans were packaged and sold as brand new securities with perfect ratings caused the Great Recession of the 2008 to begin. Their demise led to a decline in the market confidence and a cascade of the financial institutions that could suffer exposure losses. Similar to how stablecoin Terra USD was believed to be impenetrable until its demise. According to Caitlin Long, a former managing director at the Morgan Stanley, who is now building Custodia, a Wyoming-based cryptocurrency bank built from the ground up to make money without leverage, losses were amplified because it was backed by a software that few understood, but that the people piled into because it promised quick riches. She claims that a large portion of what was presented as innovation was actually leverage disguised as something else. Lightspeed, a venture firm with offices in Menlo Park and $10 billion in assets under management, is one of the Terra's most well-known investors. They were also among the first venture capitalists to support the cryptocurrencies, investing in Ripple in 2013 and recently increasing their total cryptocurrency holdings to $600 million. A firm representative spoke in a defined manner about the repercussions of what will undoubtedly go down as one of their most infamous investments. The spokesperson declared, "We see this as a computing paradigm change that's broader than the ebb and flow of the short-term price of the Bitcoin. Specifically in infrastructure, DeFi, and emergent use cases, we're doubling down." Su Zhu of Three Arrows Capital, a co-founder of another significant investor, claimed on the Twitter that Luna's failure to succeed was down to its execution rather than its core value proposition. The Luna hashtag is still prominently displayed on the Zhu's Twitter page. At least Zhu refrained from getting a Luna tattoo, like another major supporter and founder of the Galaxy Digital, Mike Novogratz. What he intends to do with the ink is still a mystery. The sadness of this situation is that, while greed undoubtedly played a significant role in the Luna's demise, its establishment was motivated by a desire to preserve the crypto's decentralized ethos, which the burgeoning stablecoin industry had been forsaken. Tether and USD Coin, the two most valuable stablecoins by the market value, with a combined market valuation of $126 billion. Although they are based on blockchain technology, they are nonetheless managed by very centralized businesses that have occasionally been very secretive about the assets used to collateralize their forms of the digital currency. Tether has generated particularly intense controversy since it invests 40% of its assets in commercial paper with an untraceable origin. However, Tether was only one of many rivals who appeared to profit from the Terra's demise. While Tether initially lost its peg, it swiftly regained it, regaining its position as a relatively secure haven. The cryptocurrency that powers the DAI stablecoin, MKR, rose 38% in the days after the collapse. According to Raghu Yarlagadda, CEO of Falcon X, investors were switching from Tether to USDC for all their stablecoin demands in the middle of the last week. USDC was being purchased at a 2.5x premium to market value. What was particularly intriguing towards the conclusion of the week was the rotation away from the USDC and towards fiat. Dante Disparate, Chief Strategy Officer of Circle, who argued that Luna's failure reflected negatively on the whole stablecoin sector and referred to the UST as a stable in name-only token, was maybe the most disgruntled rival. He asserted that the use of the more than $3 billion in the cryptocurrency collateral by the Terra founder Do Kwon revealed the enterprise as a centralized company operating under a decentralized banner. Disparate claims that the behavior of Terra in its meltdown really flew in the face of the concept that Terra was entirely decentralized, since it took a handful of the people and handful of the promissory remarks on the Twitter to either unravel it or to try to salvage it. And that seems capricious and arbitrary, in addition to being centralized. The fact that Luna's founder Do Kwon made it a point to announce rivals didn't help. In March, he claimed that it was entertaining to watch ventures fail and tweeted that DAI, a similarly designed stablecoin founded in 2014, would be destroyed by USD. Algorithmic stablecoins, according to some commentators like Yusko and ARK Invest's Yassine Almandra, will never be successful. While technological problems that were resolved and applied by the other developers caused the majority of the previous crypto resets, it appears that the solution in this case already exists. Fiat-backed stablecoins, according to Almandra, a lot of the institutional investors and influencers who were hammering the drum on some of the more experimental efforts that were going on in the crypto are probably feeling extremely humbled by this discovery. I believe the notion of the algorithmic stablecoins as a worthwhile endeavor is dead, the author said. The way the market reacts to this sudden shock will determine how quickly and how these questions can be answered. Over the previous 6 months, cryptocurrency has already lost more than $1 trillion in value, with Bitcoin falling from highs about $70,000 to below $30,000. The possibility that this is the first macro crypto bear market where institutions like Tesla have the asset on their balance sheets increases the urgency. In reality, MicroStrategy, the largest corporate Bitcoin holder in the world, with 129,000 tokens and an average purchase price of $30,700, is currently experiencing a loss for the first time in the company history. The good news is that most investors don't appear to be in a panic, which should caution the market's blow. Ironically, that might be because investors were already withdrawing funds when Luna and Terra fell. According to Nicholas Panigarzoglu, managing director of the global market strategy at JP Morgan Chase, the sector saw some de-risking in the crypto space even before Terra's collapse. According to the mean reversion at the Bitcoin began in October, investors started to cut back on their bets on the cryptocurrency in the latter half of the 2021. The DeFi industry has expanded as well, despite years of charges that it's nothing more than a Ponzi scheme. It's making an effort to become more business-friendly. Versions that are only accessible to institutions have been released by the two prominent platforms, AAVE and Compound, and Compound's service even got a B grade from the Standard & Poor's. Although the protocol itself only has roughly $150 million under management, and the debt is not investment grade, and it's a start in the right direction. What are your thoughts on this video? Please share your thoughts in the section below. Do not forget to click the subscribe option if you want to hear from us again.